Hello everyone, I hope you all are doing very well, and in the series of evaluation metrics playlist, the next question that we are going to see is why are metrics like MAPE, that is mean absolute percentage error, preferred in financial forecasting, and many of the important conclusion we can made from this session. And for researchers who are beginners in this field, definitely grasp some important points, and definitely it is going to helpful for you. So please watch it till the end and subscribe the channel, like the video. And if you are having any question meanwhile watching the video, you can ask in the comment section, right? Okay. So basically in financial forecasting, metrics like MAP, which is stands for mean absolute percentage error, are often preferred because of the several specific reason and the nature of financial data and the requirement of financial forecasting task. The very first one is interpretability and transparency. Mean absolute percentage error provides measure of forecast accuracy in percentage terms, right? And which is very much easier to interpret holders and decision makers in the financial domains, right? This matrix is going to express errors relative to the actual value. So let's say if the actual value is 100 and the predicted value of any stock is 110, so there is a difference of 10. So it reflects that 10% fluctuation could be there. So easily to interpret, and decision makers can directly take the decision because this particular fluctuation is according to the actual value, right? The second thing is scale independent evaluation. So financial data can often exhibit varying scales and magnitude, making absolute error metrics less informative for comparing forecast performance across different data sets or time periods. And MAP is going to address this by normalizing errors which is relative to the actual values, and it allows for scale independent evaluation of forecast accuracy. So it is scale independent evaluation, and the varying scale or absolute error, if we are only going to figure out, that is MAE, mean absolute error. Though, so it is not going to be that much informative. It is only going to give us the numerical data, but it is going to scale independent evaluation in the terms of financial accuracy. And the third one is emphasis on proportional accuracy. So financial forecasting is proportional accuracy is very crucial in financial domain, and MAP is directly going to measure the percentage deviation between predicted and actual values, which reflects that how well forecasting is aligned with the actual values irrespective of the magnitude, right? So this emphasizes on the proportional accuracy, particularly relevant to finance, where a small percentage is also going to be very significant implications. Because let's say if any party is investing 10 crore or 100 crore, any amount of data, and if 0.01% fluctuation is also there, or 0. Let's say 10% fluctuation is also there, it is going to make a too much use money, or it may make a loss of use money. So small percentage errors also matters here. That is why proportional accuracy required. So MAP is going to fulfill that demand, right? And fourth one is handling percentage change. So financial data set, you know that we every time got the data that GDP increased by 7.1, the forecasting by IMD, or you can say that any particular agency is forecasting the India's GDP. Let's say World Bank is forecasting that this year it would be 7.8% or anything. It is just my data. So I am saying that if it is 7.7 and if it is 7.8, so there is huge difference between them, right? So each and everything is matters here. So a variable that exhibit percentage change or growth rates, for example, stock prices or inflation rate or GDP growth. So MAP is going to well suited for such kind of evaluating forecast because it focuses on relative errors and adjusts for varying magnitudes of values. And one more reason, that practical interpretation of errors. So mean absolute percentage error is help in assessing the impact of forecasting errors in real world financial decisions that we have discussed, whether it is stock market price, whether it is inflation rate, whether it is GDP change or whatever. So interpretation of errors is going to be become very easier with the help of MAP. Now comparative performance analysis. Mean absolute percentage error facilitates direct comparison of forecasting accuracy across different financial models, time periods, and forecasting horizons. And lower value of MAP indicates better forecasting accuracy. It allows analysts to identify the most reliable forecasting method for financial decision making. Because let's say if many agencies predict, World Bank predict, and many agencies predict the GDP forecast or inflation rate forecast for any country. So they obey different models, right? At the end, when the final results came, we can evaluate which agency have given the correct predictions and we can work on their model, right? So MAP is going to work very well on that, right? Okay. And then alignment with business objectives. So financial forecasting aims to support critical business decisions such as budgeting, investment planning, risk management, and resource allocation. And MAP aligns these objectives by providing metric that directly measures the accuracy of prediction in percentage terms, which is directly relevant to financial decision makers. So we can make overall conclusion that mean absolute percentage error preferred in financial forecasting due to its simplicity, interpretability, percentage terms, scale independent, emphasis on proportional accuracy, and relevance to financial decision making. And this metric enables analysts and stakeholders to access forecasting accuracy effectively, aiding in informed and data-driven financial decisions. So you can subscribe us on various social media platforms. All the links are mentioned in the description section. And guys, do like the video, subscribe, and stay tuned for more such informational videos. Have a very nice day, guys. Jai Hind, Jai Bharat.